Well, conventional wisdom says younger funds may be more risky. They may be more inclined to go under. They're unproven. But alas, that is not the case. In fact, they actually do better than some of their older peers. One fund of funds actually focuses on that very sweet spot, and we went behind the scenes.
It still is not the right time to buy.
For hedge fund manager Eric Dibesland, this is a high-stakes meeting.
We launched April 5th, to be exact, of 2006. So we're a little over 9 months old, and very much a small emerging manager. We are up to $38 million. So it's a start.
Dibesland is looking for investors, and Fund of Funds manager Eldon Mayer is looking specifically for emerging hedge funds like Dibesland's Black Gold Fund, because that's where the sweet spot is. His firm, MayerCap, studied hedge funds with $30 to $250 million under management that started up in 2003. What he found:
they outperformed the hedge fund indices by between 400 and 500 basis points. That's significant.
And that first year 4 to 5% outperformance happened again for funds started in 2004, and again for those original 2003 startups in their second year performance. So when does it end? Typically in year 7, when returns tend to match the industry's. Why is youth on investors' side? Newer funds can be more nimble.
They're smaller. They can move around in the markets without leaving big footprints.
They can invest in smaller cap stocks.
If you're a big hedge fund and you like energy, let's say, you might have to buy Exxon. But if you're a small one, you can buy a $200 million capitalization company.
And they've got a lot at stake.
They're hungry. As we like to say, they stay up half the night thinking about every position in their portfolio.
Like Dibesland, who left a successful 15-year Wall Street career to start his energy-focused fund.
I put most of my net worth into this fund. I'm really managing my own money as well.
MayerCap's assets have gone from $45 to $300 million in 2 years, thanks to strong interest from institutions, including pensions.
They are saying to themselves, alpha returns are hard to find in hedge funds, so they are looking in interesting new nooks and crannies, such as new managers.
Which is why Dibesland is hoping the meeting went well.
Hopefully we'll be able to bring him on board as a partner.
So you're hoping for the phone call?
I am hoping for the phone call.
And the capital every new fund needs.
Now, the next step for MayerCap would be a trip to Houston to check out Black Gold's operations. That trip, if it does happen, would probably take place around Black Gold's first birthday in April. But if MayerCap doesn't work out for Black Gold, there are many other fund of funds out there. Hedge fund research says there are a dozen funds with this very focus. And from what it's seeing, this area certainly is growing. Bill.
Which actually, Melissa, I have a quick question for you, which brings me to the question that a lot of people are talking about, which is whether or not we're in a formation, a bubble formation, because so many new funds. I mean, it's the thing to do, to open either your own hedge fund or a fund of funds. Are there any worries out there from the more experienced veterans on the street?
Well, in terms of the outperformance, we should note that this outperformance takes place in funds between $25 million and $250 million. Certainly, there's a lot of capital formation by guys who are, literally in their garage at the Bloomberg terminal, and they're starting up their own hedge funds with $5 million. But this outperformance tends to happen slightly larger emerging funds out there. So in terms of the concerns, it could be at the smaller end, not this range, the sweet spot of the industry.
Yeah, on the other hand, the competition is a good thing. I mean, you've got a lot of guys trying to get in and trying to outperform. The odds are that that's probably going to make everybody up their game.
And that's why they say that there is a shakeout, and when that shakeout happens, it's going to probably happen in the smaller range of the hedge funds, up to 25 million, even beyond that, because that is where it is the toughest. It's the toughest to kind of get that infrastructure going to actually prove your returns.
Melissa, thank you, as always.